The stock market is displaying early signs of technical breakdown. Right now, while most investors are watching price charts and trending headlines, a quiet fracture is spreading beneath the surface. Technical indicators that held steady for months are beginning to slip. Capital is rotating out of familiar territory, flowing into sectors that weren't supposed to matter anymore. The ceiling at 6,000 has been tested multiple times, each rejection a little weaker than the last. Moving averages are converging, and when they cross, history suggests the next move won't be sideways. But here's what almost nobody's talking about. The breakdown isn't just technical, it's structural, and the clock is already running. Welcome to the Comics Chronicles. If you've been navigating markets long enough to remember when financial news came from newspapers, not notifications, then you understand the value of analysis that doesn't chase clicks. We'd be honored if you'd subscribe to this channel, the same way you'd bookmark a source you trust when the noise gets loud. And before we proceed, drop a comment telling us where in the world you're watching this from. Geography matters in global markets, and so does your perspective. Now, let's examine what's actually happening beneath the surface. When experienced traders look at a market chart, they don't just see lines moving up and down, they see a conversation. A conversation between buyers who believe the price will rise and sellers who believe it won't. And right now, that conversation is becoming strained. The S&P 500 has approached the 6,000 level multiple times in recent weeks. Each time, it pushes upward with what appears to be conviction. Each time, it falls back. This isn't random noise, it's a pattern. And patterns in financial markets are like cracks in a dam. They start small, then they spread. Technical analysts use tools called moving averages to track these patterns. Think of a moving average as a rolling summary of where price has been over a specific period. The 1-month moving average tracks the last 30 days of price action. The 2-month moving average tracks the last 60 days. When these two lines move in the same direction, markets tend to remain stable. But when the shorter-term average begins to fall below the longer-term average, it signals something has changed. Momentum is slowing, buyers are losing confidence, and what comes next is often unpleasant. Right now, these two averages are converging. They haven't crossed yet, but they're close. Closer than they've been in months, and the financial community is watching this convergence with increasing concern. But here's where most analysis goes wrong. Many observers treat this technical signal as if it's a trigger, as if the cross itself will cause the market to fall. That's backwards. The cross doesn't create the problem. The cross reveals that the problem already exists. It's like a fever in medicine. The thermometer doesn't make someone sick. It simply confirms what the body already knows. By the time the technical indicators flash red, the underlying weakness has often been building for weeks. So the real question isn't whether the moving averages will cross. The real question is, what is causing the underlying weakness? And to answer that, one must look beyond the charts. Because markets don't move in isolation. They move in response to money flows, investor positioning, economic data, and structural changes in how capital is allocated. The 6,000 level has become what traders call a psychological resistance. It's a round number. Easy to remember, easy to anchor expectations around. When a market approaches such a level repeatedly and fails to break through, two things happen. First, buyers become hesitant. They begin to wonder if there's something wrong that they're missing. Second, sellers become emboldened. They see the repeated failures as confirmation that upside is limited. This creates a self-reinforcing dynamic. Each failed attempt to break higher brings more sellers into the market, which makes the next attempt even harder. It's a cycle, and cycles in financial markets tend to accelerate once they begin. But there's another dimension to this situation that most casual observers miss entirely. While the headline index, the S&P 500, appears stuck in place, the components inside that index are moving violently. Some sectors are rising, others are falling. Capital is not leaving the market entirely. It's relocating. This is called rotation. And rotation is dangerous because it creates the illusion of stability at the index level while masking chaos underneath. Imagine a building where the foundation is shifting. From the outside, the structure looks fine, but inside, walls are cracking, floors are tilting, and stress is accumulating in places that aren't visible from the street. That's what rotation does to market indices. It hides the real story. And the real story right now is this. Money is flowing out of the sectors that led the market higher for the past 2 years. Technology, software, Artificial intelligence adjacent names, these were the darlings. They were the stocks that everyone wanted to own. But now, that capital is moving elsewhere, into energy, into industrials, into consumer staples and materials, sectors that were ignored, even mocked, during the growth rally. Why is this happening? There are two possibilities. Either investors genuinely believe these boring sectors offer better value and better prospects going forward, or they're simply looking for somewhere to hide, somewhere that feels safer while uncertainty builds. And the difference between those two explanations determines what happens next. If it's genuine value discovery, the rotation could continue smoothly for months. If it's defensive positioning disguised as strategy, then the rotation itself could reverse violently when confidence breaks. The technical indicators can't tell us which scenario we're in. They can only tell us that something is changing. And change, in financial markets, is where fortunes are made and lost. The ceiling is holding. The averages are converging. And beneath the surface, capital is moving in ways that suggest preparation, not optimism. What comes next depends on whether the foundation can hold, or whether the cracks are already too deep to repair. Capital doesn't disappear, it relocates. This is one of the most misunderstood concepts in financial markets, and it's the key to understanding what's happening right now. When observers see technology stocks falling, they assume investors are losing money, but that's not quite accurate. What's actually happening is far more complex and far more revealing. The money that was sitting in high-growth technology names, in software companies, in artificial intelligence plays, that money is being withdrawn. But it isn't going into cash. It isn't leaving the market entirely. It's moving into sectors that most people stopped paying attention to months ago. Energy stocks are rising. Industrial companies are gaining ground. Materials, basic materials like metals and chemicals, are attracting interest. Even consumer staples. The companies that make soap and cereal are seeing capital inflows. This is rotation. And rotation tells a story that index movements cannot. Think of the stock market as a massive arena with thousands of seats. The seats represent different sectors, different investment opportunities. During a normal market environment, people sit relatively still. They pick their seats and they stay there. But when uncertainty rises, when confidence begins to crack, people start moving. They leave the seats that feel exposed, the ones high up in the risky sections. And they move toward the exits, or toward the sections that feel more protected. The total number of people in the arena hasn't changed, but the movement itself, the shuffling, creates chaos. From a distance, from the outside, the arena looks full and functional, but inside, it's disorder. That's what's happening in the stock market right now. The S&P 500, the headline index, looks relatively stable. It's hovering near recent highs. Not collapsing, not surging, just stuck. But inside that index, inside the components that make up that number, there's intense movement. And this movement reveals something critical about investor psychology. When money flows into defensive sectors, it's rarely because investors suddenly discovered value there. Consumer staples companies don't innovate rapidly. They don't disrupt industries. They don't promise exponential growth. They make products people buy regardless of economic conditions. Toothpaste, laundry detergent, breakfast cereal. Boring, predictable, stable. So when capital starts flooding into these sectors, it's not because investors are excited. It's because they're nervous. They're looking for safety. And that nervousness, that shift from offense to defense, is a leading indicator. It tells observers that confidence is eroding even if prices haven't collapsed yet. But here's the trap. When a defensive sector starts attracting heavy inflows, its price rises. And when prices rise, more investors notice. They see energy stocks climbing, and they think, I should own energy. They see consumer staples holding steady while tech falls, and they think, that's where the smart money is. So they buy. And their buying pushes prices even higher. This creates momentum. But momentum built on fear, on defensive positioning, is fragile, because the moment conditions change, the moment confidence returns, all that defensive capital reverses course. It floods back out. And the sectors that felt safe, that felt stable, suddenly become crowded exits. Prices fall, not because the companies changed, not because the fundamentals deteriorated, but simply because the trade became too crowded, and someone decided to leave first. This is the danger of rotation that most investors miss. They see capital moving into a sector and they interpret it as bullish. But rotation isn't always bullish. Sometimes rotation is just rearranging deck chairs. Now, let's examine the other side of this trade. The sector is losing capital. Technology, particularly software and AI-related names, have been under pressure. These were the sectors that dominated market gains for the past 2 years. They were the winners. Everyone wanted exposure. Valuations stretched higher and higher, justified by promises of future growth, future disruption, future dominance. But now, those valuations are being questioned, not necessarily because the technology isn't real, not because the companies are failing, but because the market is reassessing what it's willing to pay for future growth versus what it can get from current cash flow. When interest rates are low, future growth looks attractive. Investors are willing to wait, willing to pay premium prices for companies that might dominate in 5 or 10 years. But when rates rise, when uncertainty increases, when volatility picks up, future growth becomes less appealing. Investors want returns now, not someday. They want dividends, buybacks, tangible cash flow. And that shift in preference, that pivot from growth to value, is what drives rotation. The index itself, the S&P 500, is dominated by a small number of very large companies. 7 or 8 mega-cap technology firms represent an enormous portion of the index's total weight. So when those companies fall, even modestly, it creates downward pressure on the index. But that pressure is being offset, partially, by gains in other sectors. Energy up, tech down, staples up, software down. The net result, the index appears stuck. But underneath, there's violent movement. And this is why relying solely on index levels can be deeply misleading. The index says, everything is fine, we're near all-time highs. But the internals say, capital is fleeing risk, seeking shelter, preparing for something. Those are two very different messages, and the difference between them is what separates those who see what's coming from those who are blindsided when it arrives. Rotation doesn't announce itself with sirens. It happens quietly, gradually, until suddenly it doesn't. And by the time the majority notices, the move is already over. There's a moment in every economic cycle when the ground beneath the market begins to shift, and most participants don't feel it until it's too late. That moment isn't announced. There are no headlines that say fundamental conditions are changing now. Instead, it reveals itself through small inconsistencies, data points that don't quite align, market movements that contradict the prevailing narrative, and policy signals that get misinterpreted again and again. Right now, the global financial system is experiencing exactly this kind of quiet transition, and the consequences are only beginning to surface. Consider inflation. For 2 years, it dominated every conversation about markets. Central banks raised interest rates at the fastest pace in decades, trying to cool an economy that was running too hot. Businesses adjusted pricing, consumers changed spending habits, and gradually, the fever began to break. Recent data shows inflation retreating from its peaks, not collapsing, but cooling, particularly in one critical area, housing. Housing costs represent the largest single component of consumer price measurements. When rent increases, inflation rises. When rent stabilizes, inflation moderates. But here's the complexity that most analysis overlooks. The way housing costs are measured has a built-in delay. Official statistics track something called owner's equivalent rent, which is essentially what homeowners estimate they would pay if they were renting their own property. This measure moves slowly. It lags behind what's actually happening in real-time rental markets by several months, sometimes longer. So by the time the official numbers show housing inflation cooling, private market rents have often already turned the corner. This lag creates a dangerous misperception. Policymakers see the official data and believe inflation is still sticky. Market participants see private market data and believe inflation is already defeated. Both are looking at the same economy, but seeing different timelines. And in that gap, mistakes get made. The Federal Reserve has held its policy rate in a restrictive range, waiting for confirmation that inflation is truly under control. They've signaled patience, they've emphasized data dependency, and they've made it clear they are not rushing to provide relief. This stance has created a tension in financial markets. Investors have been conditioned over the past 15 years to expect rescue. Whenever markets stumbled, central banks intervened. Whenever growth slowed, stimulus appeared. But this time, the response is different. The cavalry isn't coming, at least Not yet, and that changes everything. Because markets don't just react to what central banks do. They react to what central banks might do. Expectations drive positioning. Positioning drives flows. And flows determine prices. Right now, expectations are fractured. Some participants believe rate cuts are imminent, that the cooling inflation data will force the Fed's hand. Others believe the Fed will stay restrictive far longer than markets anticipate. This divergence creates volatility, not the explosive, panic-driven kind, but the grinding, uncertain kind that wears down conviction over time. And while this drama unfolds in the background, another force is quietly reshaping global capital flows: the US dollar. Currency movements rarely make headlines, unless they're extreme, but the dollar's strength or weakness affects everything. Commodity prices, corporate earnings for multinational companies, the cost of servicing debt in emerging markets, even the relative attractiveness of US assets versus foreign alternatives. Recently, there have been reports, unconfirmed but circulating in financial channels, that Russia is considering a return to dollar-based settlement mechanisms for certain trade transactions. If this materializes, it has profound implications. Not because Russia alone moves global markets, but because of what it signals about demand for dollars. When more global trade flows through the dollar, more dollars are needed in the system. That demand supports the currency. A stronger dollar creates winners and losers. It pressures commodities priced in dollars, making them more expensive for foreign buyers. It creates headwinds for U.S. exporters, whose goods become less competitive abroad, and it tightens financial conditions, even without any central bank action. This is the hidden mechanism that most investors ignore. Monetary policy isn't just about interest rates. It's about the entire ecosystem of credit availability, currency strength, and liquidity conditions. And right now, that ecosystem is tightening. Not dramatically, not catastrophically, but steadily. Meanwhile, energy markets are sending mixed signals. Energy stocks have been among the strongest performers in recent months. The narrative supporting this strength is straightforward. Artificial intelligence build-out requires massive data centers. Data centers require electricity. Electricity requires fuel. Therefore, energy demand must rise. Logical, compelling, and potentially incomplete. Because while electricity demand for AI infrastructure is real, it's only one piece of the energy puzzle. Global oil markets are still navigating supply management challenges. Natural gas demand varies by region and season, and the gap between what energy companies are priced for and what they're actually delivering in cash flow is widening. This creates a vulnerability. When a sector rallies on narrative rather than fundamentals, it becomes crowded, and crowded trades, no matter how logical they seem, eventually correct. The question isn't whether the correction will come. The question is what triggers it and how violent it becomes. All of these factors, inflation dynamics, monetary policy stance, dollar strength, energy sector positioning, are converging, not in isolation, but simultaneously. And when multiple macro variables shift at once, markets struggle to find equilibrium, prices swing, correlations break down, and the strategies that worked for months suddenly stop working. This is the macro foundation beneath the technical breakdown. The charts are showing weakness because the underlying conditions are becoming unstable, and instability, once it takes hold, tends to accelerate. There's a force moving through the economy right now that doesn't fit into traditional market analysis. It doesn't show up cleanly in inflation data. It doesn't appear in central bank policy statements. And it can't be captured by technical indicators or sector rotation patterns. Yet it may be the most consequential factor of all: artificial intelligence. Not as a concept, not as a buzzword, but as an actual operational capability that is advancing faster than most institutions are prepared to handle. And the implications are beginning to ripple through financial markets in ways that few investors fully comprehend. For the past 2 years, AI has been treated primarily as an investment theme. Companies with AI exposure saw their valuations soar. Semiconductor manufacturers, cloud infrastructure providers, software platforms that claimed AI integration all benefited from the narrative. Money poured in, multiples expanded, and for a time, it seemed like the entire technology sector would rise indefinitely on this single story. But something has changed recently. The AI-adjacent stocks that led the market higher are now leading it lower. Software companies are being repriced. Mega-cap technology names are facing selling pressure. And the sectors that were supposed to be the primary beneficiaries of the AI revolution are suddenly among the weakest performers. Why? Because the market is beginning to ask a different question. Not which companies will benefit from AI, but rather, which companies will survive AI? And that question carries very different implications. Senior executives at major technology firms have begun speaking publicly about timelines for when AI tools will be capable of automating significant portions of white-collar work, not in some distant future, but within the next 12 to 18 months. These aren't speculative statements from researchers. These are operational assessments from people running billion-dollar enterprises, and their words carry weight, because if they're even partially correct, the entire structure of knowledge work is about to shift. Now, does this mean every office job disappears next year? No. Organizational change moves slowly, migrating workflows, overcoming regulatory constraints, navigating internal politics. These things take time. But here's the part that matters for markets. The capability curve is steepening. What required a team of specialists 6 months ago can now be done by one person with the right tools. What took days now takes hours. And the cost is approaching zero. This creates an incentive problem. If a business can achieve the same output with fewer people, competitive pressure will force them to make that choice. Not because executives want to eliminate jobs, but because competitors who adopt the technology will gain cost advantages. And in capitalism, cost advantages compound into market share. Then market share compounds into survival. So the question isn't whether AI will disrupt labor markets. The question is how fast and which sectors get hit first. The market is already pricing in answers. Software companies that sell tools to enable human productivity are being reassessed, because if the humans themselves can be replaced, the productivity tools become less valuable. Customer support platforms, data entry systems, junior-level analytical services, these businesses face existential questions, and investors are beginning to ask those questions before the earnings reports confirm the damage. But there's a paradox embedded in this story. While AI threatens certain business models, it also creates demand in others. The infrastructure required to run large AI systems is enormous. Data centers consume electricity at levels that strain local power grids. Cooling systems, server farms, network capacity, all of this requires capital investment. And that investment has driven strength in energy stocks, in industrial companies, in material suppliers. The narrative has been simple. AI build-out equals infrastructure demand equals sector strength. But narratives have a dangerous quality. They can run ahead of reality. And when they do, prices become detached from cash flows. Energy stocks have rallied on the assumption of persistent demand growth. But what if the demand growth is front-loaded? What if the initial build-out phase is followed by a plateau, and while the market is still priced for exponential expansion? That gap between narrative and delivery is where corrections happen. And those corrections tend to be swift, because the same investors who piled into a sector based on a story will pile out just as quickly when the story changes. This creates a dual risk in the current market environment. On one side, companies being disrupted by AI are seeing their valuations compressed. On the other side, companies benefiting from AI infrastructure demand may be overpriced relative to the actual cash flows they'll generate. Both scenarios lead to the same outcome: downside pressure. And when both happen simultaneously, the index itself struggles to find support. Now, there's another dimension to this that extends beyond markets. If AI genuinely begins to displace labor at scale, societies will face questions they're not prepared to answer. What happens when productivity rises, but employment falls? What happens when corporate profits increase, but household incomes stagnate? These aren't abstract economic theories. They're political realities that will demand responses. Already, discussions about universal basic income are resurfacing, not as fringe ideas, but as serious policy considerations. Because if the entry-level rungs of the labor ladder get removed, entire generations may struggle to gain footing in the economy. And when large populations feel economically insecure, political instability follows. Markets don't price this indirectly, but they sense it. They sense it through volatility, through defensive positioning, through the rotation out of growth and into perceived safety. Because underneath all the technical analysis and sector rotation, there's a deeper current, a recognition that the economic structures which supported the last decade of market gains may not support the next decade. Investors who built wealth by buying technology and holding through volatility are beginning to question whether that strategy still works. Because the technology sector itself is being restructured, winners and losers are being separated, and the separation is happening faster than valuations can adjust smoothly. This is why the current market environment feels different. It's not just a normal correction. It's not just profit-taking after a strong run. It's a recalibration, a reassessment of which business models survive, which sectors genuinely benefit from technological change, and which narratives were built on hope rather than fundamentals. And recalibrations, by their nature, are messy. They don't follow clean patterns. They don't resolve quickly. And they punish investors who rely on the strategies that worked in the previous cycle. The technical breakdown at the surface is real. The rotation beneath the index is real. The macro uncertainties around inflation and monetary policy are real. But the variable that ties them all together is disruption. Technological disruption that is accelerating, economic disruption that is spreading, and market disruption that is just beginning. The question now is not whether markets will adjust. They always do. The question is how much damage occurs during the adjustment and who is positioned to survive it. Because in every transition, there are winners and losers, and the distance between them is growing wider.